Welcome to Kenton Teaches. Enjoy the video.
A Heloc lets you borrow against your home equity up to a typical 80% combined loan-to-value. Lenders set the maximum based on your remaining mortgage and appraisal value. Heloc interest is usually variable, and you typically pay interest only during the draw period. Draw periods commonly last 10 years, then repayment begins. You can use a Heloc to cover a down payment, for example 0, 0, 0, 0, or the FHA minimum 3, 5%. Always confirm lender rules and seasonal restrictions before planning a purchase. Open a Heloc and confirm available credit and any draw restrictions first. Ask the lender about draw periods, interest adjustments, and required collateral documentation. Withdraw funds and document the transfer to the new home purchase account carefully with bank statements. Provide a clear paper trail for your mortgage underwriter and keep copies of transfers. Expect to disclose the Heloc on mortgage applications and meet any seasoning rules that restrict recent equity withdrawals. Coordinate timing so the Heloc is active before escrow closes. Heloc rates are variable, so budget for rate increases and possible payment spikes. Closing costs, appraisal fees, and possible setup fees usually range from 0 to 0 depending on the lender. Remember that using a Heloc increases your combined loan-to-value and could push you above 80%. Maintain at least a 20% equity cushion to protect your financing options. Consult your mortgage lender to confirm they accept Heloc funds for down payment and to understand any specific documentation requirements.
Thanks for watching. Please subscribe if this video was helpful.